Welcome to the deep dive. We're here to sift through the noise, find the signal, and really cut through complexity for you.
That's the plan.
So today, we're diving into something you hear constantly in finance news, in boardrooms: shareholder value.
A big one.
Yeah, and if you follow the markets, you know it's not just jargon, right? It's like the engine behind so many company decisions.
Absolutely. Decisions that can sometimes seem, well, baffling from the outside.
Exactly. So our mission today is to really unpack what shareholder value means, how companies measure it, and maybe uncover why chasing it leads to some surprising moves, like, selling off a part of the business that's actually making money.
That's right. It's fundamental. If you've ever wondered why a company snaps up another one, or suddenly buys back loads of its own stock, or even, like you said, discontinues a product line that seemed popular,
Yeah.
shareholder value is almost always lurking in the background. It's the main lens for judging performance.
Okay, let's peel back those layers then. Start at the beginning. What's the absolute core idea here?
Well, fundamentally, it comes down to the investor's perspective.
Right.
Anyone putting money into a company, a shareholder, is asking, is my money working hard enough for me? Am I getting a good return here?
Because if not, you'd put it somewhere else. A bank account, maybe?
Precisely. If you can get a better, safer return elsewhere, why risk it in this company? So management is constantly under pressure to prove they're generating value.
And how do they show that? What's the value we're talking about?
It's basically two things. First, the cash they actually pay out to you, usually as dividends.
Okay, direct cash.
And second, the increase in the price, the market value of your shares over time. So income now plus growth later.
Got it. Which brings us to the metrics. How do we start measuring this? You mentioned dividends, so let's start there. Yield. What does that tell us?
Yield is probably the most direct measure of that immediate income part.
Okay.
It's simply the annual dividend the company pays out per share, divided by the current market price of that share.
Yeah.
Usually expressed as a percentage.
Can you give us an example? Like, make it concrete.
Sure. Say a company's shares are trading at 20, and it pays out a dividend of €1 per share over the year.
Right.
1 divided by 20 is 0.05, so that's a yield of 5%.
Simple enough. 5% cash return based on the current price.
Exactly. And how do they figure out that dividend per share? They look at the total profit they've decided to distribute and divide it by how many shares are out there.
Okay. But you mentioned before it's not just about the number itself.
No, not at all. What's fascinating here is how yield reveals different investor appetites, different strategies.
How so?
Well, you've got investors who really want that immediate income. Maybe they're retired, living off investments. They'll actively seek out high-yield shares. That 5% might look very attractive to them.
Okay, the income seekers.
Then you have others, often called growth investors, who are perfectly happy with a low yield or even zero yield.
Why would they accept that?
Because they're betting on the other part of shareholder value, the share price going up. They believe the company will reinvest its profits wisely, grow bigger, become more profitable in the future.
And the share price will reflect that down the line.
Precisely. They're trading immediate income for the potential of much larger capital gains later. So that yield figure kind of flags which camp a stock might appeal to more.
That's a really clear distinction. One number, two different philosophies.
Okay, but like you hinted, companies don't usually pay out everything they earn, do they?
Almost never. No. They keep some back. Retained earnings.
Retained earnings, right. And this is where it gets, well, maybe a bit more complex, but also potentially more revealing.
I'd say so. Because only looking at dividends misses a big piece of the puzzle, the profit the company is holding on to, hopefully to generate more profit in the future.
So how do we measure that? The profit that belongs to shareholders, whether it's paid out or not.
That's where earnings per share, or EPS, comes in. It's a really core metric.
EPS, heard that one a lot. Yeah, you see it everywhere. It's calculated by taking the company's total profit after tax and dividing it by the total number of outstanding shares.
So it's the slice of the profit pie attributable to each individual share.
Exactly. Let's use an example. Say a company makes $1 million in profit after tax, and it has 4 million shares outstanding.
Okay.
1 million divided by 4 million shares gives you an EPS of 25 cents.
25 cents of profit generated for every share out there.
Correct. It gives you a much clearer picture of the company's underlying profitability on a per-share basis, regardless of how much they decide to pay out as dividends. You generally want to see EPS growing over time.
Right. Signals a healthy business.
Yeah.
Okay, so we have yield for income, EPS for underlying profit per share. Now, what about the one everyone quotes? The price-earnings ratio. The PE ratio.
Yes, the PE ratio. Probably one of the most widely used and sometimes misunderstood metrics.
So let's clarify. What does it actually tell us?
Well, it directly connects the market price of a share to its earnings. You calculate it simply by dividing the current share price by the earnings per share, the EPS we just discussed.
So using your example, share price was 5, EPS was 25 cents.
Right. So 5 divided by 0.25 euros. That gives you a PE ratio of 20.
20. What does that number 20 signify?
It means that investors are currently willing to pay 20 euro for every one of the company's annual earnings. Or, put another way, it would take 20 years of current earnings to equal the share price.
Okay, so is 20 high, low, good, bad?
And that's the million-dollar question, isn't it? It's all relative. You have to compare it.
Compare it to what?
To the company's own historical PE range, to the PE ratios of its competitors in the same industry, or to the average PE of the broader market.
So context is key.
Absolutely crucial. A high PE ratio, say, significantly above the average, often means investors have high expectations for future growth.
They expect the E part, the earnings, to increase significantly.
Exactly. They're willing to pay a premium today for earnings they expect to materialize tomorrow. It's pricing in future success. Think of fast-growing tech companies. They often have very high PE ratios.
But that's a bet, right? It could be overvalued if the growth doesn't happen.
Definitely a risk. High PE stocks can be more volatile. Conversely, a low PE ratio might suggest the market has lower growth expectations for the company. Maybe it's seen as undervalued, a potential bargain.
Or maybe the market thinks its prospects are dim, and it's cheap for a reason.
Precisely. It could be a value trap. So the PE ratio isn't just a number. It's a reflection of market sentiment and growth expectations. You can't just look at it in isolation.
Okay, that makes a lot more sense. It's about the story the market is telling about the company's future.
Mm-hmm.
Now, let's tie all this back, yield, EPS, PE ratio, to that big goal. Maximizing shareholder value. How does this drive actual decisions in the executive suite?
Well, this is where the rubber meets the road. Because investors are watching these numbers yield, EPS growth, the PE multiple. The market assigns management knows their performance, and often their compensation, is tied to improving them.
So they're under pressure to make those numbers look good.
Intense pressure. Maximizing shareholder value, in practice, means using all the company's resources, its assets, its people, its potential in the most profitable way possible.
The most profitable way. That sounds quite demanding.
It is. If we connect this to the bigger picture, it guides major strategic choices. Making the right acquisitions, for instance, buying companies that will boost earnings and hopefully get a higher valuation multiple.
Okay, buying growth. That makes sense.
But, and this is often the harder part, it also drives divestment. Selling off parts of the business.
Selling divisions, even ones that aren't losing money.
Exactly. This is a key point. It's not just about getting rid of loss-making units, though that happens too. It's about divesting business units that, while perhaps profitable, are not generating enough profit.
Not enough compared to what?
Compared to the company's other businesses, or compared to what shareholders could theoretically earn elsewhere with similar risk, they might have an internal hurdle rate, a minimum acceptable return on capital. If a division isn't clearing that hurdle,
it could be sold, even if it's making money and employing people?
Yes. That's the, you could say, ruthless logic of maximizing shareholder value. If capital can be deployed more profitably somewhere else, either in a different part of the existing business or by returning it to shareholders who can invest it elsewhere, then the pressure is there to sell the underperforming unit.
Wow, that really highlights the intensity of that focus. It's not just be profitable, it's be maximally profitable with the resources you have.
That's the essence of it. It can lead to difficult decisions, breaking up companies, selling well-known brands, all in the name of optimizing returns for the owners, the shareholders.
Okay, so wrapping this up then, understanding these terms, yield, EPS, the PE ratio, and this driving principle of maximizing shareholder value, it really gives you, our listener, a powerful lens, doesn't it?
It absolutely does.
You look at financial news, company announcements, those big strategic shifts, and start to see the underlying logic, the why behind the what. They stop being just abstract numbers.
They become the language of corporate strategy and investor expectations. My final thought on this is, once you start looking at businesses through this lens, you really begin to understand the pressures and priorities shaping the corporate world.
You see it from the inside almost.
Sort of, yeah. You see why management makes the choices it does. And maybe this is the important question to leave folks with, right? Considering this intense focus, this drive to divest even profitable units if they aren't maximally profitable, what does that tell us about the potential trade-offs?
Trade-offs, like what?
Well, the trade-offs between hitting those pure financial targets for shareholders and, say, other things a company might value or society might value, things like stable employment in a community or investing in long-term R&D that might not pay off for years, or environmental considerations that cost money now.
Right. Is maximizing shareholder value always aligned with those other goals?
That's the critical question, isn't it? How does this singular focus balance against broader responsibilities? Something to definitely mull over.
A really powerful question to end on. It certainly puts the whole concept in a wider perspective. Thank you for walking us through that.
My pleasure.
And thank you for joining us on this deep dive. We hope unpacking shareholder value gives you some new tools for understanding the business world. Until next time, keep digging deeper.